E. Understand the relationship between revenue and receivables and revenue and inventory. Revenue and accounts receivable are closely linked in credit sales environments. When revenue grows faster than receivables, turnover improves. Accounts receivable may increase disproportionately, potentially signaling relaxed credit policies or collection problems. Monitoring days sales outstanding, DSO, helps assess whether revenue growth translates into timely cash inflows. Revenue and inventory are interconnected through sales volume and demand forecasting. If inventory increases faster than revenue, it may indicate overproduction, slow-moving goods, or demand overestimation. Conversely, declining inventory alongside rising revenue suggests efficient inventory management. Analyzing these relationships helps detect earnings quality issues. Significant mismatches between revenue growth and working capital accounts may indicate aggressive revenue recognition or operational inefficiencies. Effective analysis ensures revenue growth is sustainable and supported by sound operational management. F. Determine and analyze the effect on revenue of changes in revenue recognition and measurement methods. Revenue recognition policies determine the timing and measurement of reported sales. Changes in recognizing revenue at shipment versus delivery, or over time versus at a point in time, directly affect reported income trends. Measurement adjustments such as estimating returns, discounts, and performance obligations influence net revenue. Modifying assumptions can accelerate or defer revenue, impacting profitability and financial ratios. Policy changes may distort comparability across periods. Analysts must review disclosures to understand whether revenue growth results from genuine business expansion or accounting changes. Aggressive recognition increases risk of restatements or earnings reversals. Careful evaluation of revenue policy changes helps assess earnings quality and sustainability. G. Analyze cost of sales by calculating and interpreting gross profit margin. Gross profit margin is calculated as sales minus cost of goods sold divided by sales. It measures the percentage of revenue remaining after covering direct production costs and reflects pricing strategy, cost control, and operational efficiency. A declining gross margin may indicate rising input costs, competitive pricing pressure, or inefficient production. Conversely, improving margins suggests stronger cost management or enhanced product differentiation. Trend analysis provides insight into operational sustainability. Consistent margin improvement strengthens profitability, while volatility may signal supply chain instability or fluctuating demand. Comparing gross margin across periods and competitors helps assess competitive positioning and cost structure effectiveness. H. Distinguish among gross, operating, and net profit margins and analyze component changes. Gross profit margin reflects production efficiency, operating profit margin measures operating performance, and net profit margin reflects overall profitability. Each level incorporates additional cost layers, operating expenses, and then financing and taxes. Changes in operating margin often result from variations in selling, general, and administrative expenses. Effective cost control improves operating profitability without necessarily changing gross margin. Net margin is influenced by financing decisions and tax strategies. Higher interest expense or tax rates reduce net profitability, even if operating performance remains stable. Analyzing margin components helps isolate performance drivers. Understanding which cost category causes margin shifts allows management to implement targeted corrective actions. 1. Define and perform a variation analysis, percentage change over time. Variation analysis measures percentage change in financial statement items between periods. It is calculated as current period minus prior period divided by prior period. This technique highlights growth rates and performance trends. IT allows identification of significant deviations from expectations or historical patterns. Large increases in expenses relative to revenue growth may signal inefficiencies or cost pressures. Variation analysis enhances budgeting and forecasting accuracy. By understanding historical change patterns, managers can develop more reliable projections. Combining percentage analysis with absolute dollar changes strengthens interpretation. Both magnitude and proportional change are important for meaningful financial evaluation. J. Calculate and interpret sustainable equity growth. Sustainable growth rate, SGR, represents the maximum rate at which a company can grow without external equity financing. It is calculated as return on equity ROE times retention ratio, 1 minus dividend payout ratio. SGR links profitability and dividend policy to growth capacity. Higher ROE and higher earnings retention support faster sustainable growth that if actual growth exceeds SGR, additional debt or equity financing is required. This may increase leverage and financial risk. Understanding sustainable growth helps align strategic expansion with financial capacity. It ensures growth plans are consistent with internal profitability and capital structure constraints, supporting long-term financial stability.